I'm Paul Giannamore. I'm an investment banker and I negotiate for a living. In any given year, more than half the transactions we advise on tend to be with private equity firms. So today I thought I would take the opportunity to have a discussion with you, and I've put together a list of the most common questions I get from my clients with regard to private equity. So let's go ahead and dive right in. How do private equity firms use debt in ways that most business owners don't? Every private equity firm is a little bit different with regard to their philosophy on the use of debt. Debt allows a private equity firm or allows anyone to juice returns, right? The more debt you put on something, the more returns you get to invested equity. The issue becomes when something is so debt laden, it becomes quite risky. I find that most private equity firms are still pretty judicial, at least in the middle market, with their use of debt. But private equity firms have the ability to take on far more debt than you do. So, for example, you own a middle market business, you might be able to take on 1 or 2 turns of EBITDA in debt, whereas private equity firms sometimes can get 3, 4, 5, 6, 7, 8 times EBITDA in debt. So, I do think private equity firms have access to debt capital that you don't, and are often willing to utilize it, but not to such an extent that I think it puts your transaction at risk. How much control will I have after taking on a private equity investment? Now, this kind of strikes at the heart of what sort of an investment was it? Is it a control investment? Just by definition, the private equity firm will have control, right? If they own a majority of the business, they will have control. From a minority perspective, if they're investing in buying a minority stake in the business, now you will have control, but you'll sign a document that has consent rights on it, and you'll hand over, or you'll contractually hand over some rights that would otherwise be yours as a majority shareholder to the private equity firm. Like, for example, you might see that you can't make an acquisition without the permission of the private equity overlords. You can't spend X amount in capital expenditures without permission. There's a variety of different things that you would contract to. And those contracts are largely based upon the leverage you have at the table when you're closing the transaction, and how the rights and responsibilities between private equity and you impact the ultimate goals of both parties going forward. But I would say that that question is largely asked by individuals who intend to sell the majority of their business, so 60, 70, 80, 90%, remain on as CEOs. And what they're asking is how much control will they have, and every private equity firm is different, and there's a spectrum. Some will pretty much allow you to run the business exactly the same way you are today, and others will require dramatic change, and there's everything in between. And so that's one of the things you need to do. And there's no one answer to this. As you start getting out into the market and thinking about what it is that you want, you'll be able to set yourself up so that the private equity firms that are congruent with your line of thinking will self-select. What are some of the key factors in determining the valuation of my company? Now, of course, there's a lot of consistencies in valuation methodology from company to company, but there are some nuances in various different industries. I would say at its core, private equity is a cash flow buyer. A lot of you guys out there own businesses, and there's a lot of rules of thumb related to revenue multiples, irrespective of what industry you're in, but industries that tend to have recurring revenue, right? Software, SaaS, pest, lawn, whatever, tends to focus a little bit more on revenue multiples than they should. But at the end of the day, cash flow always drives value, not revenue multiples. And private equity firms are cash flow buyers. Key factors in valuation is really, valuation is inversely related to risk. And so if you can think about all the factors that increase risk in your business, if you can de-risk the business, you're making it more valuable. Obviously, cash flow drives valuation. So the greater the cash flow is, and the greater or the faster that stream of cash flow is growing, the more valuable the business will be. Can private equity help me grow my business faster? It's possible. Right? It depends upon what sort of resources and capabilities you need. Do you lack capital? Like, do you have all these great ideas and a great business? You just need more money to capitalize on it? Yeah, they can certainly help you with that. Do you not really understand some of the dynamics of your customers, and you need some data analytics, and you need some chief financial officer, and you need all sorts of capabilities? Sure, they can help you with that too. There's a lot of ways. Look, private equity firms are in the business of buying businesses and selling them. That's literally how they make money, right? They buy it for price X and they sell it for price X times 3 or X times 4 or X times 5. So they are probably focused on growing your business more than you are today. So yes, they can certainly help with that. So the last question here, I got a call from a guy about 4 months ago who said to me, Paul, what's the best way I can create a sense of urgency without looking desperate? I said, well, so what are you asking me here? He said, well, look, I've been dealing with a private equity firm for a few months. I really like these guys, and I think they're willing to put a pretty big offer on the table. They've said as much. We've had some dinners. We've signed an NDA. We traded some numbers back and forth, and they keep telling me that the offer is forthcoming, although it just doesn't show up. And so I wanted to give them a call and say, hey, should I get off the pot? And, you know, me as an advisor, I look at that and say, I would never want to be in a position of just dealing with one buyer. It didn't make sense to me. And I explained it as such. And subsequent to that conversation, he ultimately engaged us, and we're going to be taking that business out to a formal process. And he handed off the contact information to me, that private equity firm. And we gave him a call, and the private equity firm wasn't as nearly interested in the business as he had thought they were. And, sometimes I think this might be sellers projecting desire. But in this particular case, I do think that they kind of strung him along. I think that they talked some big numbers, talked a big game, didn't ultimately produce the offer, which of course happens sometimes. I mean, this is deal making. You've got to expect this. So you can't take it too seriously. But when we had the conversation with the private equity firm, they just said, they're not interested in moving forward with us in a formal process. So that shows me their level of interest. Thank you for joining me today as I discuss my clients' most common questions regarding private equity. If you've got any questions, feel free to reach out to me directly on the contact form in the description below, or join me on LinkedIn. My name is Paul Giannamore. Thank you for joining me today, and I'll see you on the next one.